The reverse DCF addresses many of the shortcomings of a traditional DCF model, and it's far simpler and easier to use. Those benefits are causing it to rapidly gain popularity amongst investors and analysts alike. In this video, we'll provide a complete overview of the reverse discounted cash flow model and show how investors can use this powerful valuation tool to make better investing decisions.
Okay, Brian, but if we're going to be talking about a reverse discounted cash flow model, it's worth at least tackling what's a discounted cash flow model.
A traditional discounted cash flow model is a valuation method that is used to estimate the fair value of investment based on its future cash flows.
With the discounted cash flow model, you've got two inputs: the business results, for instance, free cash flow or earnings, and then your assumptions about the type of growth those things will have into the future.
So you put the results and your assumptions into a discounted cash flow model, and what the model spits out is the current stock price that a company should trade at based on those numbers.
All right, so what is a reverse discounted cash flow model? The simple definition is a valuation method used to estimate the implied growth rate of a stock based on its current market price.
Unlike our traditional discounted cash flow model, with a reverse discounted cash flow model, you input two knowns. First, the company's business performance, such as free cash flow. Second, you enter in the current stock price.
Throw those two inputs into the model, and what it spits out is an assumed growth rate into the future.
So with the discounted cash flow model, you're solving for the estimated stock price. With a reverse discounted cash flow model, you're entering the stock price and you're solving for the assumptions built into it.
So why do we prefer a reverse discounted cash flow model? Because it's far simpler and there are fewer assumptions input into the model.
So how does a reverse DCF work? Well, using it requires an 8-step process.
The first step in the process is simply to find a reverse DCF calculator. Now, you can search the internet and find a number of different options that vary in complexity, but we've tried to simplify this for you.
We decided to build our own reverse discounted cash flow model in Google Sheets. And if you want access to this tool, there's a link to a free download in the notes below.
Once you've found your calculator, the next thing you need to do is identify what stage of growth is this company in.
Now, this is a critically important step because reverse discounted cash flow models don't work on all companies at all times.
In fact, the reverse DCF model is most useful when a company is in stage 4 or stage 5, where it is maximizing its margins or even returning cash to shareholders.
A reverse discounted cash flow model can be useful when a company is in stage 3 or in stage 6, but it's not as useful as when a company is in stage 4 or stage 5.
And if we're talking about a young startup that's in stages 1 or 2, the reverse DCF will be almost entirely useless.
So how can you tell which stage of the business growth cycle a company is currently in? Well, we created a free tab in our download, and if you put some inputs in about revenue, gross profit, and more, the model will spit out and tell you which phase a company is in.
Next, we need to move on to step number 3, which is to enter a stock symbol. Now, if you're using our sheet, this means that we're going to be focusing on this box in the upper left-hand corner.
So this step is very easy. We simply enter the stock symbol of the company we're going to be looking at. In this example, we're going to be looking at Alphabet, aka Google, whose stock symbol is GOOG.
All right, after that, we move on to step 4, which is to enter a company's free cash flow over the trailing 12 months, or TTM. Next, you need to actually find that figure. You can find this in a number of places. We prefer to use stratosphere.io. If you go to the website and punch in the ticker symbol, you will see the screen here.
Once you pull up a stock symbol, you click on this link, which says the cash flow statement. Then you click on this button here that says free cash flow, and you're going to be entering in this number in the lower right-hand corner, which in this case is Google's trailing 12-month free cash flow for the year ending 2022.
Now that number was roughly $60 billion, so we input that number into our sheet and we move on to step number 5.
Step number 5 is estimating a company's terminal growth rate. What does that mean?
The terminal growth rate estimates how fast a company will grow once it has completely saturated its market. In general, that should be about equivalent to the GDP of the economies where it operates.
As a rough guideline, this number should be typically between 2 and 4%. So in Google's case, we'll input a terminal growth rate of a free cash flow of 3%.
Step 6 is to enter an appropriate discount rate. Now, what does that mean?
Discount rate is a complex topic, but at its core, it is the required rate of return an investor demands for owning a particular asset.
In general, safer investments mean that you require a lower rate of return, but riskier investments require a higher rate of return. We believe that discount rates in general should be between 8 and 12%. That means that you expect to get an 8 to 12% return every year on this investment.
Now, in Google's case, we think it is a normal risk business, so in this case, we're going to be using a discount rate of 10% for Google.
Finally, we look at the company's growth rate over the next 10 years. We're going to play with this number until its current and intrinsic values match.
So next, we're going to be inputting different growth rates for Google's free cash flow over the next 10 years, which will change its estimated intrinsic value. We're going to keep making changes to that until its current share price and its estimated intrinsic value match.
So let's start out by assuming that Google will grow its free cash flow by 15% per year over the next 10 years. When we input that 15% growth rate, what the model kicks out is an estimated intrinsic value of roughly $169, and we can see that's far higher than the stock trades for today.
So that means that 15% growth rate is too high, and we need to bring that number down until the current and estimated intrinsic values match.
So let's lower that growth rate down to 10%. When we do, we see that the prices are much closer at $116, but we can still fine-tune it.
So we'll reduce that estimated growth rate to just 9%, and by doing so, we get an estimated intrinsic value that nearly matches the company's current share price.
So now that we've landed on a growth rate, let's step back and look at what we're saying is happening. We believe that Google will grow its free cash flow by 9% per year over the next 10 years, and then for as long as it exists after that, it will grow at roughly 3% per year.
Now, once we know the growth rates that are built into a company's current valuation, we can ask ourselves a simple question. Do these implied growth rates seem too optimistic, about right, or too pessimistic? If they're too optimistic, that means Google stock would be overvalued today, which would be a bad thing. If the growth assumptions seemed about right, that would mean that Google stock is fairly valued today. And if the growth assumptions seem way too pessimistic, that would mean that Google stock would likely be undervalued today.
Now, the more familiar you are with the company, the better you'll be able to tell, but we do have a few ways to look for this. The first is by simply looking at the company's history of free cash flow growth. If you go to stratosphere.io and you click on this chart right here, it will spit out its free cash flow over the past 10 years. And it even calculates that Google has grown its free cash flow by about 20% per year over the past decade.
So over the past 10 years, Google has grown its free cash flow at a compounded growth rate of 20%, but over the next 10 years, the current stock price implies that Google will only grow its free cash flow at 9%. That could indicate that the assumptions built into Google's stock price today are too low.
A second proxy that you can use is to head on over to Yahoo Finance. You click on the Analysis tab and you scroll to the bottom of the screen where it talks about growth estimates over the next 5 years.
Doing so shows us that analysts currently believe that Google is going to grow its earnings at a rate of 15% per year over the next 5 years. Now, it's important to note that that's relating to earnings, not free cash flow, but it is a decent proxy that we can use. We think this is an incredibly powerful valuation tool, and if you want free access to the tool that we created, simply click the link in the video description. Brian's out.